Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And obviously yesterday's market reaction to the vaccine news and somewhat of the election news, we've had some big moves. So today what we want to discuss is how did the market react, a little bit of information about the vaccine itself, and more importantly, what we expect going forward. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. So this does not be construed as a recommendation or advice to buy or sell any specific securities. Now, we'll start off by talking a little bit about the vaccine breakout, if you will, of the broader markets and how the major market indices have reacted to it. Now, I will break down a little bit about the details of the vaccine itself, what challenges we see with the distribution of it, and talk a little bit about the backdrop of the COVID and employment data that we're currently looking at from an economics perspective going into this type of news event, which gives us an understanding as to why the reaction that we saw from the markets have been so strong, what the reactions have been, what sectors you should pay attention to, and more importantly, going forward, what you can expect from some of those sectors, and then view some of our ideas here before we open this up for Q&A here at the end. But the primary question that I want to help investors really understand from this session is really how do you anticipate what markets are going to do going forward post the Pfizer vaccine news? So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you my charts, the research that we're currently paying attention to, and the economic research that we are looking at for our views. So we'll start off by taking a look at Pfizer. Normally we take a look at the markets. We'll look at Pfizer first. So Pfizer, initially off the news, took off quite a bit, but after the open here on yesterday, traded substantially lower from there. And I think this reflects the knee-jerk reaction that we predominantly saw from the markets on the news of this vaccine, which certainly was better than expected in terms of the efficacy of the vaccine. But markets gave back a lot of those gains here, and this speaks again to that knee-jerk reaction that we saw from the broader markets here. But Pfizer is opening up higher here today, so I do think that for this breakout here, we can consider this roughly $39.5, $39 resistance level that has been in place for quite some time here for Pfizer as broken, and has the potential to continue higher here. As you can see, Pfizer has, if you look on the weekly chart here on the left-hand side, has been in a long-term downtrend. Pfizer has been a long-term downtrend, and we finally broke out above that downtrend. So right now, there are some resistance levels here to the upside in 44, 46. Those are the targets that I think we would start taking a look at here for Pfizer. But keep in mind that there's a few things that are important. The reason that some of the markets reacted so strongly is really the backdrop that we have seen in COVID-19 cases here in the U.S. Yesterday, we had 130,000 new cases here in the United States. 44 states are still rising, meaning the number of cases in 44 states are 10% higher than they were 7 days ago. That is concerning. That's why the markets have reacted so strongly to this news, because of the optimism around the rollout of this vaccine. However, I do want to point out here that there are some major distribution challenges specifically to the Pfizer vaccine. So this is a chart here of COVID-19 vaccines from different pharmaceutical companies. You have AstraZeneca and Johnson & Johnson, you have Moderna, and then you have Pfizer all the way down here. And what this scale tells you is the temperature at which the vaccines need to be stored at during the distribution. And as you can see, AstraZeneca and Moderna are near, some of the other vaccines and distribution centers that have or distribution logistic companies that have the ability to distribute vaccines at this particular temperature. But Pfizer is all the way down here. And generally speaking, there aren't many distribution logistics companies that have the ability to distribute them. So Pfizer has to be it can't just rely on traditional distribution. They have to actually build their own specific boxes in order to allow the distribution. The Pfizer vaccines have to be stored at about 70 degrees below Celsius. So this is a big challenge from a logistics perspective, and I think this is part of why the markets initially reacted very strongly and then pulled back a little. This, certainly this is good news, especially given the number of COVID cases, but it is important to understand the distribution challenges of getting the vaccine out, and this doesn't even reflect the fact that, number one, even in a best case scenario, we're looking at about 50 million doses by the end of this year. Even Pfizer does, at this point project 1.3 billion vaccines at the end of next year. But, that's still 12, 13, 14 months away before you're really seeing wide distribution of this type of vaccine. So when we look at some of the industries that reacted very strongly yesterday, we need to take into context, number one, how is the distribution of this vaccine going to play out, and when can we expect, the vast number of people that need a vaccine to actually receive it in order for these industries to recover. So those are some of the things we want to explore here today. So let's take a look at how markets reacted here. So the S&P 500 reacted very strongly, breaking out outside of the range that we talked about here last week. Last week we talked about this 352, 330, 323 range that the markets were trading in. We were expecting markets to get rejected at that level because they were short-term overbought. Money flow was starting to look weak here, but on the vaccine news, markets did end up breaking out higher here to the upside. Now, largely the markets have given back most of those gains, and we're trading just at the upper bound of that range. And the question from many investors right now is, is this a breakout, or is this a breakout that's going to continue moving higher? Or is this more of a failed breakout and we're going to come back into the range? So in order to help answer that question, taking a look at other indices perhaps can give us some clues. If we look at the QQQ, the NASDAQ 100 index, this is the part of the market that has been leading us higher. So the NASDAQ 100 broke out from the February highs back here in early June and has continued moving higher here. But the QQQ yesterday did not break out higher like the S&P 500, got rejected at the 295 range and is now trading pretty much in the middle of that range right now and is actually opening up pre-market a little bit lower than the close yesterday. So our expectation here, at least for the NASDAQ 100 index, is to remain in this range and potentially trade to the lower end of the range because, number one, this is simply just a clinical trial news. This is not the release of the vaccine to the general public. We may see an emergency use authorization in the next month or so for this vaccine based on the news that we saw here yesterday. But again, that has not been in place yet, and there are some massive distribution challenges with this particular vaccine. So markets kind of initially reacted very strongly, gave back some of those gains, and it's important for us to see how markets react going over the next couple of days. Does this enthusiasm fade a little, especially if we look at some of the other industries? But the one thing I will point to is that we have continued to see a lot of strength from small caps. Small caps was the best performing major industry yesterday here in the US. Is opening up higher than the close yesterday, one of the few indices opening up higher than yesterday versus both S&P and NASDAQ moving lower than yesterday. So IWM breaking out above that 160 level, breaking out above this 165 recent high here, and is now trading at 172, which is pretty much in line with its all-time high that it put in back in December of 2018 or late 2018. So this is an important level here for small caps. Small caps, for the most part, keeping up with a broader rally here from the March lows, started to underperform for a couple of months here from pretty much July or so till about now, and now outperforming again the broader markets. This is the one part of the market that is constructive for markets to continue moving higher. I think that once we see a little bit more clarity as to the distribution of these vaccines, perhaps when we see some of the other vaccines that don't require such cold storage in order to get approved, that is really where the S&P will open up and perhaps break out higher here. But this all points to what I would consider a fairly healthy market rally here. So there are, we're seeing some pretty big divergences between the indices. So you have the momentum NASDAQ 100 index lagging behind, with small caps, a value, if we think of them as more value stocks, really leading behind. This is starting this, if anyone has heard this rotation into value, we're seeing this in play right now. And this vaccine has effectively accelerated this rotation into value. When we look at RSP, which is the equal weight S&P 500 index, also breaking out to new all-time highs. Now, the S&P, this is trading just around yesterday's close here, which happens to be just around the all-time high. So we'll see how this reacts today, if it comes back and fills that gap, or if it continues moving higher here. My guess is that it will fill this gap here and perhaps then continue moving higher. But this is one that I think is very important to watch to give us a better understanding as to how markets are moving. Now, why do I say that? I think that it's more likely you're going to see this gap fill first before markets can continue moving higher. This is the number of stocks that are trading above its 200-day moving average. It's currently trading at 71%. This is a new all-time high. And notice how in the February 2020 highs, that reached about 68%. So right now, we are near an extreme level reading in terms of the number of stocks trading above its 200-day moving average. We see this on the number of stocks trading above its 20-day moving average, which currently sits at about 71%. The number of stocks trading above its 50-day moving average, also 71%. Those are not at the same extreme levels. The 20 and the 50-day have gotten higher, but the 200-day at 71%, that is a fairly extreme reading here. So long term, these are, you have a lot of stocks that are trading above its moving averages. Sometimes we see a bit of give back on those types of extreme readings. The one thing that has moved substantially is volatility. Volatility initially took a very large move to the downside based on the U.S. election, from about a little over 40 down to the 27 handle, and on vaccine news moved down to the 24 handle. If we look at that, that basically is the pandemic lows. Pretty much we have not seen readings lower than this since the start of the pandemic, with the exception of just a very short period here between June, around August or so, going into the run-up before the September sell-off here. So volatility during the pandemic, post the pandemic, at near what I would call all-time lows. So this is an opportunity for those of you that are seeking some opportunities over the next few weeks, next couple of months or so, to look at some opportunities where you can start buying some volatility. We've been predominantly selling volatility over the past couple of months, but we've now started to take a look at some buying opportunities because, again, volatility has come down substantially due to this. So looking around the world, so U.S. equities starting to break out higher, but if you look at the major indices, still kind of range bound here, not really giving us the true catalyst of that move higher here, even though the vaccine news should have been that propellant. We have not quite seen that breakout, but emerging markets have seen that breakout. Emerging markets, EEM, breaking out above this $46 level. We talked about this here last week. If you look at Japan, if you look at the specific countries, even higher here. So these are predominantly countries that have lower COVID cases. U.S., one of the highest in terms of percentage of our population in terms of COVID cases around the world. Here, we're looking at just the countries with lower cases continue to outperform here. So if we're looking for outperformance here from equities, looking internationally, looking at countries that have lower COVID cases and a higher exposure to certain industries like Japan, those are the countries that you might want to take a look at. Now, when we take a look at SLV silver, so one of the things that we wanted to take a look at was gold and silver was a big, I would say, thesis on many investors' mindsets last week, because we started to see a breakout here in gold, started to see a breakout in silver, we started to see a breakout in Bitcoin. This was all predominantly based on concerns around using these as a hedge against inflation because of stimulus. Now, so far, that breakout has failed, but the breakdown or the initial reaction to the downside hasn't been particularly strong, in my opinion. I think The thesis for a potential breakout here still remains. We're trading more of like a triangle here, I think, and what we need to see is another breakout here. But for now, this triangle is still intact, which is this consolidation pattern that we're looking at, and we're still waiting for that breakout here. So I don't think this trade is invalidated. I just think that we need to wait a little longer for that breakout. So looking at some economic data. So employment data came out on Friday, which largely kind of got washed out a little bit based on the election news and based on the vaccine news yesterday. But payrolls came out substantially better than expected. We were expecting about 580,000 jobs, came out at 638. And in terms of the employment, in terms of number of jobs, we're still about 10 million jobs behind where we were pre-COVID. But we initially had what we considered a V-shaped recovery. That clearly is starting to slow down here. And this is one of the concerns that I think from an economics perspective that we have with respect to employment. Employment is coming better than expected, but it's still definitely slowing down here. And one of the things that we want to point out here is the big surge that we had was the unemployment rate. Expectations were about at 7.6%, came in at 6.9%, which on the surface looks really good. But the one thing that I still want to point us to is the fact that the underemployment rate is still at 12%, meaning the amount of the number of people that are underemployed, meaning they're not employed in the jobs that they want to be in. They have to take a lower paying job or a job that they don't necessarily want because that's the only thing available, is still very high. And I think this is the important level to pay attention to make sure that this continues to decrease back to normal levels. Those are the ones that we want to pay attention to. Now, when we look at opportunities going forward, now, the U.S. 10-year took a very negative reaction to the U.S. election and then had a very strong reaction to the vaccine news here over the past couple of days. This is really one of the big movers here. So for those of you looking for that rotation into financials, this provides further support for that rotation into financials. For those of you that followed us, we continue to use KRE as the vehicle, in my opinion, to play for this upside here for interest rates, because regional banks are the sector of the market that are most sensitive and most highly correlated to longer term yields like these 10-year yields. So KRE is the vehicle that I would look at playing this continuation here to the upside for yields. You can also short bonds, but I think KRE, because KRE does pay a fairly sizable dividend yield, that's the one that you want to pay attention to. Now, looking at the sectors or the segments of the markets that had a strong reaction to yesterday's vaccine news, this is really where, from my perspective, you have to ask yourself, did the move yesterday, did that fundamentally change things immediately for this particular sector or this particular stock? How long does the vaccine need to be in place for these sectors to really start turning around or start reversing lower? And did the move yesterday, was that a little too big, too fast? And I think this is really where it will pay off, in my opinion, to be a little bit contrarian and a little bit ask the question a little bit as far as, did things materially change as much as the market reacted yesterday? And I think a good example of this is American Express. American Express rallied roughly 20% here, a little over 20% here yesterday. American Express, large underperformer of the pandemic, because American Express has a very high exposure to higher income and corporate travel, both segments of the markets that were lagging behind on the recovery. Higher income spent less than lower income families off the recovery. They're actually below pre-pandemic levels. And corporate travel remains roughly 90% below last year's levels. Has this vaccine changed things that drastically? And I think this is an example where I don't particularly think that it warranted a 20% move here in a stock like American Express, because for higher income families to feel comfortable enough to start spending more money and for corporate travel to start picking up, that's likely still a year and a half away from now. So I think a 20% reaction perhaps was a little too far too fast. Now, I certainly do think that the lows here around 92 will hold, And I do think that vaccine is probably going to be strong enough for this to hold. But my expectation is that you're going to see this fade a little bit before this can continue moving higher. That's my personal opinion, and that's how I think you should think about or be a little skeptical about some of the big moves here. But if we look at just the overall trends, if we look at home builders have been one of the strongest sectors off of the pandemic lows as we all shift from working from offices to working from home. And as we spend more time in our home, we're going to improve our home. So the XHB Home Builders ETF has really been one of the net beneficiaries of it. But one of the things I will point out here on the recent moves to the upside, momentum has been slowing down. And the fact that we have this double top here around 58, I think that double top is likely going to hold. Even if you get another reaction here to the upside, as we realize this vaccine is going to take some time before we all get it and the benefits of it flow into the economy, this is likely going to be the type of ETF that maybe found a bit of a temporary top here as a result of the vaccine news going forward. But this is how I'm starting to think about the broader markets. If we look at the airlines made a big move here to the upside. If you look at JETS, which is the ETF that you can use to track most of the international airlines, the one thing I will point us to is that we're still below this $22 resistance level, which is off of what I thought also a bit of a knee-jerk reaction back here in early June that the airlines had. So right now, just to put this into context, the big move that we had yesterday is still below this index. So the question is really how markets react. I think it's going to give back a little bit before it kind of becomes more of a range-bound trade here and potentially then break out. But I'm not expecting that this just continues its move higher and continues moving higher. If it does, I would, at least from my perspective, question that move a little because are people all of a sudden going to start rushing and then get back onto a plane? The answer is no. It's going to take quite a bit of time before you get a vaccine, before you actually get back on that plane. And for the meantime, we've actually seen airline travel decline a little bit over the last month or so, especially in the leisure side. Corporate travel remains depressed and not moving at all. Leisure travel is still fairly actually declining a little bit. If we look at pharma, this is the one part where I do think that the breakout reaction was relatively muted, which from my perspective is actually good. I think when you get a really strong reaction, that's when I start to question that move out, that breakout here. Here you've got a slightly muted reaction. It did break out above this $47, $48 level here. So this is the type of opportunity where you could see pharma start to break out here, especially as, there's still quite a few clinical trials out there from other vaccine providers that, on those types of news, you're likely going to see a jump here to the upside. So pharma looking a little bit more constructive. You look at XLP taking a big move here to the downside. From my perspective, XLP looks very similar to the broader equity indices, and I think you're more likely to see perhaps some range-bound action here for XLP. If you look at energy, if you look at from a sector ETF, I think one of the biggest movers yesterday, 14% here on energy. But put this into the context of the larger move. That move to the upside was barely a blip on the radar here. So a lot of investors asking, is this a turnaround that you're looking for from energy? From my perspective, maybe you get a little bit more here to the upside, but long term, notice this downtrend here. From my perspective, I think these are more shorting opportunities rather than a true reversal, if you will, of the energy complex. If you look at XLY, the one thing I will point you to is the fact that XLY tried to break out multiple times, higher highs, each time momentum moving lower here. This leads me, especially when the money flow is so weak, this leads me to believe that this is more likely going to trade to the downside here. So XLY kind of reaching a bit of a temporary top here. The vaccine news kind of forcing this, making it harder for this segment to continue moving higher. I think for investors, they're putting their money in other places that they think have better opportunities than consumer discretionary as a sector that has been very, very strong off of that off of the March lows here. If you look at communications, very similar as well. Communications benefited a lot from the work from home and the lockdown. And this is also something that we're likely going to see a temporary top in here. I think a lot as investors, look at these types of reopening, lockdown stocks. They're definitely going to shy away from the lockdown stocks, especially as we expect more vaccines to come down the line. I think investors are going to be a little gun shy of playing for breakouts here to the upside because they're concerned that, if as more vaccine news comes out, as Pfizer perhaps gets authorization and starts distributing, you're less likely to see investors still pull the trigger, especially at some of these communication companies trading at near all-time highs. Industrials did break out here to the upside. My expectation is that you're likely going to see a retest of this resistance level. I'm curious as to see if those resistance levels hold, because if they do, then you do have the potential of industrials starting to move higher. If you look at Caterpillar, if you look at John Deere, these are the types of names that are focused on, because as those are the types of companies that will be a net beneficiary of reopening trades and kind of infrastructure spending that is likely going to come as we take a look at some of these. Real estate, real estate had a very strong knee-jerk reaction initially to that breakout, but gave back pretty much all of the gains here yesterday, and it's back in the range here. I think the challenges for real estate here are long-lasting. I don't think that vaccines will all of a sudden get people rushing back to their office. I think a lot of people are rethinking, do I even need to be back in an office even if vaccines are available and everyone is vaccinated? Do I need to commute into the city every single day? And the answer is, I think things have fundamentally shifted here. So real estate, I think this is more of a failed breakout than a real true breakout that's going to change this industry as a result of what we have seen. So taking a look at some opportunities here. So McKesson, this is a pharmaceutical delivery company. This is not a company that Pfizer is actually using. But I do think that, we have a long-term underperformance, a long-term basing, and now we're starting to see the breakout here of that base here. So for some of the other pharmaceutical companies that are building vaccines, this is a company that is going to get some attention here and may continue moving higher here. This is a company that the US government has tapped to look at some pharmaceutical delivery of some of the other vaccines. On the flip side, look at some technology stocks that have, look at NASDAQ 100, look at how weak it is. Look at Intel. Intel recently broke down below this $48 level, came back to retest this as resistance, and is starting to move lower here. So from a technology perspective, think about weak stocks that are likely going to continue moving lower, like Intel. And then looking at Boeing, a lot of questions about airlines. Again, Boeing, big move to the upside, but put it into the bigger context, still below the 200-day moving average, still a long-term underperformer. Does this change the 737 MAX drastically from my perspective? Not really. I think you're more likely to see continuation lower here off of this initial reaction. So with that covers what I wanted to share with you here today. I hope that you guys find this useful in helping give you a better understanding as to the broader view of the markets. There's a lot of reactions here to the market, a lot of knee-jerk reactions, and from my perspective, be a contrarian. That's going to hopefully help you become a smarter investor here over the next few days. So thank you so much. Have a great trading day, and I'll see you guys here next week. Thank you so much.